Have you ever noticed how the people who play it safe with their money often end up worse off than the people who take calculated risks? It's one of those things that doesn't make sense at first. You'd think doing the responsible thing would protect you, following the conventional wisdom, putting your money somewhere safe. But here's what nobody tells you about the traditional safe investment path. It's not actually protecting your wealth. It's quietly eroding it, year after year, dollar by dollar. Here at Simple Money, I've spent years watching people make financial decisions, and I've noticed something disturbing. The people who think they're being the most careful with their money are often the ones losing the most purchasing power over time. Today, I'm going to reveal exactly how the so-called safe path is bleeding your wealth dry, and more importantly, what you can actually do about it. Let's start with what's really happening here, because this isn't about being reckless with money. It's about understanding a fundamental truth that most people miss entirely. When you put your money in a savings account, you feel responsible, smart, like you're doing the adult thing. Your parents probably told you to save money. Your teachers reinforced it. Society celebrates it. But here's the uncomfortable reality. That money sitting in your savings account is losing value every single day. Think about it this way. Imagine you have a bucket with a tiny hole in the bottom. You can't really see the water leaking out. But every hour, every day, a little bit drains away. That's what inflation does to your savings. Right now, most savings accounts pay you around 1% interest per year. Some pay even less. Meanwhile, inflation has been running between 3 and 7% over the past few years. Do the math. If your money grows at 1% but loses value at 4%, you're going backwards by 3% every single year. On $10,000, that's $300 of purchasing power just vanishing. Not because you spent it, not because you made a bad decision, but because you made what everyone told you was the safe decision. Here's where it gets even more frustrating. The financial industry has conditioned us to think this is normal. They call it a savings account. The word savings implies you're building something, accumulating wealth, getting ahead, but you're not saving anything. You're just losing money more slowly than if you stuffed cash under your mattress. Now let me show you the 5 specific ways this safe path bleeds your wealth. Each one is working against you right now, and most people don't realize it until it's too late. The first one I call the inflation illusion. This is the big one, the one that does the most damage over time. Here's how it works. You look at your bank account and see the number going up. You deposit your paycheck, maybe you get a little interest. The balance grows. Your brain sees progress. But that number on the screen is lying to you, because what matters isn't the number of dollars, it's what those dollars can actually buy. Let's say you saved $10,000 5 years ago. That same $10,000 today can't buy what it could back then. Your groceries cost more, your rent costs more, gas costs more, everything costs more. But your bank balance still says $10,000. It looks the same, feels the same, but the actual purchasing power has shrunk dramatically. This is why the inflation illusion is so cruel. You think you're maintaining your wealth. You're watching that number stay steady or grow slightly. Meanwhile, your actual ability to buy things with that money is deteriorating month after month. The average person loses about 20 to 30% of their purchasing power over a decade by keeping money in traditional savings. That's not a small amount. That's hundreds or thousands of dollars just evaporating from your financial future. And here's the psychological trap. Because the number looks stable, you feel secure. You're not motivated to do anything different. You keep following the same pattern that's slowly destroying your wealth. The second pattern is what I call the opportunity drain. This one compounds the damage from the inflation illusion. When your money sits in a savings account earning 1%, you're not just losing to inflation, you're also losing every opportunity that money could have pursued. Think about it. Every dollar you have can only be in one place at one time. When it's sitting in that savings account earning essentially nothing, it can't be anywhere else. It can't be invested in the stock market, where it could potentially grow 7 to 10% per year over time. It can't be used to start a side business that might generate income. It can't even be used to pay down high-interest debt that's costing you 15 or 20%. Every day, your money sits idle, you're paying an opportunity cost. The difference between what you're earning and what you could be earning. Let's make this concrete. Say you have $20,000 sitting in savings for 10 years at 1% interest. At the end, you'd have about $22,000. But if that same money was invested in a simple index fund averaging 8% returns, you'd have over $43,000. That's more than $20,000 in opportunity cost. Money that could have been yours but isn't because you chose the safe path. Here's what makes this particularly painful. You can't get those years back. Time is the most powerful force in building wealth, and every year you wait to start investing is a year of compound growth you can never reclaim. The people who understand this start investing early, even with small amounts. The people who don't keep waiting for the perfect moment, waiting until they have more saved, waiting until they feel ready. Meanwhile, the opportunity drain keeps bleeding their potential wealth year after year. The third pattern is the safety paradox. This might be the most counterintuitive one. Here's the paradox. By trying to keep your money completely safe, you're actually putting your financial future at greater risk. Let me explain. When people say they want their money to be safe, what they usually mean is they don't want to see the number go down. They want zero volatility, no ups and downs, just steady and predictable. So they avoid stocks because stocks go up and down. They avoid real estate because property values fluctuate. They stick with savings accounts and maybe bonds because those feel stable. But here's what they're missing. Short-term stability often creates long-term risk. By avoiding the temporary ups and downs of investing, you guarantee that inflation will erode your wealth. You've eliminated the short-term risk of volatility, but you've accepted the long-term certainty of losing purchasing power. It's like refusing to exercise because you don't want the temporary discomfort of being out of breath. Sure, you avoid that immediate discomfort, but you've guaranteed your long-term health will deteriorate. The safety paradox tricks people into thinking they're being cautious. In reality, they're taking the biggest risk of all, the risk of not having enough money when they need it most. Think about retirement. If you save for 30 years in a savings account, you might accumulate a decent pile of money. But because of inflation, that money will buy far less than you think. You feel safe today while guaranteeing you'll struggle tomorrow. The people who actually achieve financial security understand this paradox. They accept short-term volatility because they know it's the only path to long-term growth that outpaces inflation. Now here's where things get really interesting. The fourth pattern is what I call the knowledge gap tax. This is the price you pay for not understanding how money actually works. And it's more expensive than you think. Most people learn about money from their parents, who learned from their parents, who grew up in a completely different economic era. In the 1950s and 60s, you could actually build wealth in a savings account. Interest rates were higher than inflation, but that world doesn't exist anymore. The rules changed, and most people are still playing by the old rules. The knowledge gap tax shows up everywhere. It's paying fees you don't understand on investment accounts. It's not knowing how to evaluate different financial products. It's being unable to calculate whether a financial decision makes sense. Here's a perfect example. Someone tells you they're getting 3% annual returns on their investment. Sounds pretty good, right? But if you don't understand inflation, you don't realize that 3% return might actually be zero or negative in real terms. You can't evaluate whether that's a good deal or not because you're missing the framework to think about it properly. The financial industry loves the knowledge gap tax. They market products that sound great but deliver poor results. High-fee mutual funds, whole life insurance when term insurance would be better. Savings accounts marketed as high yield when they're still losing to inflation. And because most people don't have the knowledge to evaluate these products, they accept whatever seems safe or whatever their bank recommends. The knowledge gap tax isn't just about the money you lose directly. It's about all the better opportunities you never even know exist. It's about staying on the safe path simply because you don't know there are better alternatives. The fifth and final pattern is the delayed action penalty. This one compounds everything else we've talked about. Here's how it works. You know deep down that keeping all your money in savings probably isn't optimal. Maybe you've heard you should invest. Maybe you've read articles about compound interest. But you keep delaying. You tell yourself you'll start investing once you understand it better, once you have a bit more saved up, once the market seems less scary, once you have more time to research. And every month you delay, the delayed action penalty grows. Because remember, time is the most powerful factor in building wealth. Starting to invest at age 25 versus age 35 doesn't seem like a big difference. It's just 10 years. But those 10 years can easily mean hundreds of thousands of dollars difference in your retirement account. Let's say you invest $300 per month starting at 25. By 65, at 8% average returns, you'd have about $1 million. Start at 35 instead? You'd have about $450,000. Same monthly contribution, just started 10 years later. You lost over $500,000 to the delayed action penalty. Here's the psychological trap behind this pattern. Delaying feels safe. You're not making a mistake by waiting. You're just being cautious, doing more research, being responsible. But inaction is a decision. Choosing not to invest is choosing to lose to inflation. Choosing to wait is choosing to pay the delayed action penalty. The people who build wealth understand this. They don't wait for perfect knowledge or perfect conditions. They start with what they have and learn as they go. But here's what nobody wants to admit. And this is where things get really interesting. The safe path isn't actually about protecting your money. It's about protecting your ego. Think about it. If you keep your money in a savings account and inflation erodes it, you can tell yourself it's not your fault. The economy did it, inflation did it. You were being responsible. But if you invest and the market goes down, even temporarily, you have to confront the fact that you made a decision that led to a loss. Even if it's the right long-term decision, it feels like your fault. This is why so many people stick with the safe path even when they know it's not optimal. It's not really about the money. It's about avoiding the feeling of having made a wrong choice. The safe path offers psychological comfort. You can blame external forces for your lack of progress. You never have to feel like you screwed up. But this comfort costs you everything. Your future financial security, your retirement, your ability to handle emergencies. All sacrificed so you never have to feel the temporary discomfort of making an active financial decision. Let me tell you about two people I know. We'll call them Sarah and Michael. Sarah graduated college 6 years ago with about $15,000 in student loan debt. Not terrible, but not nothing either. She got a decent job making about $50,000 per year. Sarah was terrified of making financial mistakes, so she did what everyone told her was safe. She minimized her student loan payments to save money. She built up a savings account with about $12,000 in it. She kept everything in that savings account because it felt secure. 6 years later, Sarah still has about $8,000 in student loan debt. Her savings account has grown to $18,000. She feels like she's been responsible, steady, doing the right thing. But here's what Sarah doesn't realize. That $18,000 in savings has lost about 25% of its purchasing power over 6 years. It might say $18,000, but it buys what about $13,000 would have bought 6 years ago. Meanwhile, she's been paying 4% interest on her student loans for 6 years, paying hundreds of dollars in interest that could have been avoided. And the opportunity cost? If she'd invested even half of that savings over the years, she'd likely have several thousand more in real wealth. Sarah feels safe, but she's actually been losing ground for 6 years straight. Now let me tell you about Michael. Similar situation. Graduated the same year with similar debt and similar income. But Michael did something different. He kept 3 months of expenses in savings for emergencies, about $6,000. Then he aggressively paid off his student loans within 2 years. After that, he started investing $300 per month into a simple index fund. Nothing fancy, just consistent, automatic investing. 6 years later, Michael has no debt. He still has his $6,000 emergency fund, and he has about $22,000 invested in the market. In real purchasing power, Michael is ahead by probably $30,000 or more compared to where he started. While Sarah is behind despite feeling like she's been responsible. Here's what makes this even more interesting. Sarah and Michael aren't different people. Michael isn't smarter or more disciplined or luckier. The only difference was understanding. Michael understood that the safe path was actually the risky path. Sarah believed the conventional wisdom that you should save money and avoid risk. Same starting point, completely different outcomes, all because of which framework they were operating within. Here's what most people don't realize, and this is the key insight that changes everything. The difference between Sarah and Michael wasn't about risk tolerance. It wasn't about being aggressive versus conservative with money. It was about understanding what risk actually means. Sarah thought she was avoiding risk by keeping money in savings. Michael understood that losing purchasing power to inflation was a guaranteed risk. Sarah thought she was being safe by making minimum loan payments and saving. Michael understood that paying 4% interest while earning 1% was a guaranteed loss. The conventional wisdom tells us that investing is risky and saving is safe, but that's backwards. In a world with inflation, not investing is the risky choice. Letting money sit idle while it loses value is the dangerous path. This is why financial education matters so much. It's not about learning complicated strategies or becoming an expert trader. It's about understanding basic principles well enough to make decisions that work with economic reality instead of against it. Once you understand that inflation is constantly eroding purchasing power, the entire game changes. Suddenly, a savings account isn't safe. It's a slow leak, a guaranteed loss. Once you understand opportunity cost, keeping money idle stops feeling responsible and starts feeling expensive. Every dollar not working for you is a dollar that could have been growing. Once you understand compound growth, delaying investment stops feeling cautious and starts feeling reckless. You're gambling with the most valuable resource you have, which is time. The safe path isn't safe at all. It's just socially acceptable. It's what everyone does. It's what banks encourage because they profit from your deposits. But socially acceptable doesn't mean financially sound. Popular doesn't mean effective. Common doesn't mean smart. So here's what this all comes down to. The inflation illusion, the opportunity drain, the safety paradox, the knowledge gap tax, and the delayed action penalty aren't character flaws. They're predictable patterns created by outdated financial education and clever marketing from institutions that profit when you keep money with them earning nothing. But these patterns can be broken once you see them clearly. Once you understand what's really happening with your money. The question isn't whether you can build wealth. It's whether you're willing to challenge the conventional wisdom that's keeping you stuck on the safe path. Because here's the truth. The safe path will slowly bleed your wealth for as long as you stay on it. Year after year. Decade after decade. Until one day, you wake up and realize that being careful actually costs you everything.